seems like it should make a lot of sense, right? You should be able to, catch a little piece of the action. And you're basically a matchmaker, like an exchange, or you're like 3PL. You're connecting a rider with a driver, and you're supposed to be able to take a little chunk of that, or a restaurant with a consumer, or a biker with a bike, or whatever it is that other businesses are in. And the reality is, it's pretty amazing that they can lose so much money and yet not grow, which is what that data on the chart is showing, is that they're not really growing very quickly. And we actually can look at some other data sets that we're developing, which are really cool in terms of fares, and we can look at app data and things like that. And the reality is that the growth trajectory is not inflecting in the second quarter. If anything, it's gotten a little bit worse. And it's kind of amazing. You're going out and you're selling $1 for 90 cents, and you're not growing, right? So they're losing money providing these rides, and they're not actually seeing the volume growth. And they're in a duopoly. It's not like it's a super unbelievably competitive market. I mean, everything's Lyft. In some cities, Via or Juno, but the reality is it is an intensely competitive industry. And, I think when people look back at this particular market, like what's the anomaly they're going to focus on, I think it's going to be that, the ability of these companies to continue to do, capital raise after capital raise, Tesla included, in order to generate results that look like that, is pretty disappointing. And, the question we have, and we're currently working on a lot of Uber new data sets that we have, and thinking about how to position it. I think what has sort of come out is that the actual market opportunity is much smaller than a lot of people would have expected, right? Going in, that they pulled people off public transit, they've pulled people off of traditional taxis and some, things like that, some marginal riders. And, at the end of the day, to get people to give up a second car, it's probably not a particularly viable market opportunity because you can't get an Uber in New York when it rains, right? It isn't a perfectly reliable service. You can't get an Uber in all kinds of geographies. Unless you're in an urban area going a relatively short distance, it can be very hard to find a reliable service. So what they're really doing is putting taxis and some marginal public transit riders into their cars, and to try and generate more growth, they are pricing in a way that is actually maybe not advantageous to shareholders and no longer stimulating growth, because the market just isn't there. Like, you could, at some point, you can offer something that nobody wants at a discount and it won't sell. So I think there's a lot of interesting data and work there. It's kind of amazing that it's played out as it has. If you think about the market, if you're in a duopoly, in a market that people really depend on, you should be able to price for it. So we'll have some very cool data there, I think, in the next month or so.